In the intricate and often opaque world of global finance, few origin stories illuminate the mechanics of building a true hedge fund titan as vividly as that of Ray Dalio, the visionary behind Bridgewater Associates, whose ascent from a makeshift operation in a small New York apartment to the world's largest hedge fund was not fueled by luck or secret shortcuts, but by a relentless devotion to radical truth, systematic thinking, and a lifelong commitment to understanding how economic forces shape the rise and fall of nations, markets, and institutions. To understand how Dalio built Bridgewater into a financial colossus, one must begin not with the billions under management, but with the mindset of a young investor obsessed with patterns, probabilities, and the deep mechanics of cause and effect. A mindset shaped from adolescence when Dalio worked as a caddy on Long Island golf courses, overhearing investment conversations from powerful Wall Street figures, and placing his first stock trades using money earned from lugging golf bags under the summer sun. This early exposure to markets awakened in him an insatiable curiosity about why prices move, why cycles repeat, and why certain decisions succeed while others collapse. And rather than chasing quick gains, he immersed himself in a lifelong quest to decode markets the way a scientist decodes natural laws, believing that behind every economic outcome lies a set of predictable drivers waiting to be mapped, measured, and stress-tested. After graduating from Harvard Business School, Dalio founded Bridgewater Associates in 1975, not as a polished firm, but as a scrappy advisory business run from his two-bedroom apartment, where he began producing economic research that quickly caught the attention of institutional clients because of its clarity, independence, and refusal to bend to consensus thinking. And it was this independent streak that would become the cornerstone of Bridgewater's culture as it evolved from a boutique advisory shop into a global macro investing powerhouse. Dalio's early breakthroughs came from treating the economy like a machine composed of gears, credit, productivity, interest rates, human behavior, each interacting through timeless cause and effect relationships that, once understood, could be translated into predictive frameworks capable of guiding investment decisions. And this machine-like vision of the world laid the groundwork for Bridgewater's signature approach: systematic macro strategies powered by algorithmic models derived from decades of research. But the transformation from a modest firm into a hedge fund giant required not only intellectual rigor, but cultural innovation. And it was here that Dalio introduced one of his most controversial and defining creations: the principle of radical transparency, a managerial philosophy that required employees to evaluate one another openly, challenge assumptions fearlessly, and record internal meetings so that truth, not hierarchy, would determine outcomes, a method designed to eliminate ego, bias, and blind spots from decision-making. Many outsiders saw this culture as extreme, yet inside Bridgewater, it forged a crucible of idea meritocracy where only the most robust insights survived, enabling the firm to refine its economic models to extraordinary levels of precision and resilience, culminating in major successes such as predicting the 2008 financial crisis with remarkable accuracy, a moment that cemented Bridgewater's reputation as an institution capable of seeing what others could not. As assets under management surged from millions to tens of billions, Dalio institutionalized Bridgewater's systematic philosophy through the creation of the pure alpha and all-weather strategies. The former designed to exploit inefficiencies across global markets using diversified macro positions, and the latter engineered as a risk-parity portfolio built to perform across all economic environments by balancing exposure to growth and inflation in a mathematically disciplined way that redefined modern asset allocation. These strategies did not rely on Dalio's intuition alone, but on a vast library of quantified principles, rules encoded into algorithms that translated economic patterns into repeatable trades, thereby reducing emotional interference and allowing the fund to scale while maintaining intellectual consistency. Yet Bridgewater's rise was not without turbulence, for the same radical culture that fueled its success also generated criticism, internal friction, and intense public scrutiny, especially as Dalio became a more prominent figure whose writings on debt cycles, national decline, and geopolitical shifts influenced policymakers, investors, and academics alike. revealing that Bridgewater's impact extended far beyond its returns to reshape how the world interprets macroeconomic forces. Still, it was Dalio's unwavering belief in principles, documented meticulously in his books and internal memos, that provided the backbone of Bridgewater's identity. A belief that individuals and nations prosper when they confront reality honestly, diagnose problems precisely, and design solutions systematically rather than emotionally, and these principles guided Bridgewater through crises that would have crippled less disciplined firms. As the firm matured, Dalio gradually stepped back from day-to-day management, but the machine he built, both metaphorically and algorithmically, continued operating through layers of codified decision rules, institutional memory, and a culture engineered to sustain intellectual rigor long after its founder's departure, illustrating that Bridgewater's true strength lies not in any single person, but in the architecture of principles woven into its foundation. And as we explore the decades-long evolution of Bridgewater, from its humble beginnings to its transformation into a hedge fund titan managing hundreds of billions, we begin to understand that Dalio's achievement is not merely financial, but philosophical. For he created not just a firm, but a framework for thinking about markets, life, and decision-making. A framework whose deeper mechanisms reveal themselves more fully as we examine how his ideas shaped not only global investing, but the broader discourse on how individuals, organizations, and civilizations navigate the inevitable cycles of rise and decline. Cycles that Dalio believes can be anticipated, managed, and even harnessed when one understands the underlying principles governing human behavior and economic reality. A realization that becomes clearer as we step into the next chapter of his journey, where Bridgewater's evolution, Dalio's reflections, and the global forces he has spent a lifetime studying converge to reveal the next layer of how this hedge fund giant was built and why its blueprint continues to influence thinking across the world of finance and beyond, especially as we begin to see how the interplay between principles, people, and systems forms the enduring engine that allowed Bridgewater to scale into a hedge fund giant capable of navigating crises, transforming volatility into opportunity, and sustaining a level of intellectual cohesion rarely seen in the financial industry. For at the heart of Dalio's empire lies a profound belief that organizations thrive when they are built not on personality, but on principles. Principles that function like operating systems, guiding behavior, decision-making, and the continuous evolution of the firm long after individual contributors come and go. As Bridgewater entered its period of rapid global expansion, this operating system mindset became even more pronounced, shaping how teams were structured, how debates were conducted, and how every investment hypothesis was tested through layers of stress simulations designed to expose hidden weaknesses before capital was ever deployed. And it was this rigorous commitment to pre-mortem thinking, imagining failure before it happens, that allowed Bridgewater to avoid many of the catastrophic pitfalls that ensnared competitors blinded by overconfidence or complacency. The firm's ability to codify its insights into algorithms also enabled it to detach itself from the emotional turbulence that often derails even the most talented investors. For while many hedge funds rise and fall based on the instincts of a few star managers, Bridgewater sought to build a self-correcting system in which human intuition is always paired with quantified reasoning, creating a hybrid intelligence that strengthens over time as more data, experience, and feedback flow into its models. This system-based resilience became particularly evident during major global shocks, such as the Asian financial crisis, the dot-com collapse, the Great Recession, and the pandemic era. Moments when Bridgewater's frameworks either anticipated large-scale dislocations or rapidly adapted to unfolding realities, demonstrating that Dalio's philosophy was not merely theoretical, but operationally robust across multiple decades of unpredictable financial turbulence. Yet the story of Bridgewater's ascent is not solely about algorithms and macro insights. It is also a story of human psychology. For Dalio understood that markets move not only because of fundamentals, but because of fear, greed, herd behavior, and political incentives, forces that he studied with the same intensity he applied to economic mechanisms, weaving behavioral understanding into Bridgewater's models to capture the emotional undercurrents that often precede major market shifts. As the firm became more influential, managing hundreds of billions and advising governments, central banks, and institutions around the world. It also became a lightning rod for criticism. Some accused its culture of being too rigid, others claimed its transparency was invasive, and still others questioned whether its systematic approach could remain effective in an era of increasingly sophisticated quantitative competition. But what these critiques often overlooked was the extraordinary adaptability of Bridgewater's principle-driven architecture, which continuously evolves as its teams refine their models, debate their assumptions, and update their rules in response to new information. This adaptability mirrors Dalio's own intellectual journey, for he has long believed that the greatest enemy of progress is certainty, and that the most powerful force in both markets and life is the willingness to confront one's own ignorance, a belief that shaped not only how Bridgewater invests, but how it recruits, trains, and evaluates people, seeking individuals who are not merely skilled, but intellectually humble, emotionally stable, and capable of operating within an environment where ideas are challenged with unusual intensity. As Dalio gradually transitioned out of operational leadership, handing responsibilities to a new generation of executives, many wondered whether the firm could sustain its edge without its founder's presence. Yet what became clear was that Bridgewater had been engineered precisely for this moment, with its principles, systems, and culture functioning as a durable exoskeleton that preserves coherence even as faces change, allowing the firm to maintain strategic continuity while fostering innovation from within. This capacity for generational transition underscores the deeper legacy of Dalio's blueprint. He did not simply build a hedge fund. He built an institution designed to survive him. An institution whose success depends not on individual brilliance, but on collective alignment around shared principles, continuous learning, and the disciplined pursuit of truth, however uncomfortable. And as we pull back to view the larger arc of Dalio's story, a final insight emerges, one that transcends investing and touches upon the architecture of human progress itself. That greatness, whether in markets or civilizations, arises when people acknowledge their limitations, seek out diverse perspectives, and build systems that convert insight into action with consistency and integrity. A philosophy that Dalio distilled into his writings on long-term debt cycles, geopolitical transitions, and the predictable rhythms of rise and decline that govern nations as surely as they govern markets. With this understanding, the rise of Bridgewater Associates becomes not just a financial achievement, but a case study in how disciplined thinking, principled leadership, and systemic design can transform a small, fragile enterprise into a global powerhouse whose influence extends far beyond returns, shaping how policymakers interpret economic signals, how investors allocate capital, and how organizations around the world rethink the way they make decisions. The ultimate lesson, then, is that Ray Dalio's success stemmed not from superior forecasting, but from superior frameworks that allow uncertainty to be navigated with clarity, that turn mistakes into fuel for improvement, and that demonstrate how even the most complex global dynamics can be understood through timeless cause and effect patterns when approached with humility, rigor, and a willingness to see reality as it truly is, leaving us with a blueprint that continues to inspire leaders, thinkers, and investors who seek not only to outperform markets, but to understand the deeper mechanisms that drive them. And in recognizing this, we find the enduring power of Dalio's legacy. A reminder that principles outlast individuals, systems outlast intuition, and that the pursuit of truth, when combined with disciplined execution, can build structures capable of standing firm through the shifting tides of the financial world.